Well, the government is looking to push ahead with its proposed super tax legislation, where it will tax earnings on balances over $3 million at 30% rather than 15%. It will also include taxing unrealised gains on assets, including businesses, farms and shares held in self-managed funds. There are also some concerns around whether the tax will force the retirement of highly skilled workers and impact on productivity. To find out, we're joined by lawyer Phil Broderick from the business law firm Sladen Legal. Hi there, Phil.
Hi, thanks for having me.
Yeah, not at all. For our viewers, can you just explain the tax and how it would work?
Yeah, it's an interesting tax because it's unusual in that it's based on member balances. So you look at your super member balance at the end of the financial year, assuming it's over 3 million, and then you look at your balance at the start of the year, and then whatever the difference is what they're calling earnings, and that's what's, once it goes into a complicated formula, that's what's taxed at 15%. So it's a tax on the movement of your member account balance.
One of the contentious issues, Phil, is this idea around taxing unrealised gains. How will that work, and how are people expected to fund that if they have, cash flow issues?
Yeah, that's really controversial because the reason it does tax unrealised gains is your member balance increases over the year. Part of it is income earned by the fund, but a lot of it is the increase in values of the particular assets or decrease in those value of the assets, and that bit's being taxed. Whereas when you look at the normal taxing principles, when you earn income, you pay tax. When you make capital gains tax, when you make sale capital assets and have capital proceeds, you pay tax. You don't pay tax on the way on the unrealised gains. So that's a problem. And then, as you mentioned before, how do you fund it? Well, again, you haven't got the proceeds like you normally would. So you're going to have to fund that elsewhere. Now, these tax bills will go directly to the member. So the member might have the money outside of super. They can also go to their super fund and ask for some of their member balance to be withdrawn to pay it. But if they're in an illiquid fund, like you mentioned before, that's got a farm in there or a business property, it might not have the cash to pay that tax, which is a problem.
So what happens if you actually have an unrealised loss?
Yeah, and that's the other side of it. So an unrealised loss will be because your member account balance has gone down. So maybe you invested, your underlying investments are in shares. Those shares went up and you paid this tax, and then the next year the shares go down. So you've got a loss there. Now, first of all, you paid tax on something you never actually got. But secondly, how this new tax will work is that you'll have a carry forward loss to use for future increases in your member balance, but your member balance may never increase. You might take your super out, you might die, so you'll be paying tax on gains you never made, let alone, unrealised gains.
Now, Phil, a lot of people would be thinking $3 million in a super account, that's never going to be me. That seems like pie in the sky sort of stuff. I believe it impacts about 80,000 people right now. But in time, that number of people affected by this potential legislation could swell because you could actually be captured in this due to indexation. Why do you think younger people should be keeping an eye out on this?
Yeah, so that's the second controversial part of this, is that the $3 million capper is not indexed. So, and some modelling's already been done that just your normal average wage earner at the moment, with super guarantee at 12% and earnings and growth, by the time they hit the retirement, they're projected to have $3 million. So you can see, there's going to be more and more people affected by this over time, even those who feel like, well, I'm well below 3 million, it's never going to hurt me. So
how are self-managed super funds responding at this stage? And I guess that leads me to the next question about these constant changes that we're seeing, or tweaks to the super system. What does it do to the integrity of it?
Yeah, look, I've been in superannuation a long time. There's lots of tinkering, and every time there is a tinkering, well, this is more than a tinker, but it does put confidence or decreases confidence in the system, which means that people won't put more than they have to. They won't do voluntary contributions, and so they're going to have lower, super balances going forward. You mentioned earlier that it might have problems, in relation to productivity and whatnot. Part of that's because people often use their super to invest in things which is great for the economy. If people have got less in super, there's less being invested in, startups and those sort of things. So that can have a broader effect across the economy.
Finally, Phil, you mentioned their productivity. There are some suggestions today in the financial media that this tax could lead to the early retirement of skilled workers, which then could dampen productivity. Do you put much weight behind that?
Look, it's possible. I think what's probably more likely is that those persons, if they're going to be affected by the measure, they might take their super out if they don't want to pay this tax and put it somewhere else. I don't think people will retire just because of this tax.
Okay.
But you never know, right?
Yeah. Okay, always great to speak with you, lawyer Phil Broderick. Thank you.
No worries. Thanks for having me.